Welcome back to the last segment of Chapter 4, which covers the closing process. The way I remember the closing process is I think of the word and color red. Revenues, expenses, and dividends are the three different accounts that get closed. Remember, revenues and gains are basically the same thing. Gains are the result of peripheral activities, meaning not our day-to-day operations. Like if we sold a piece of equipment for more than we paid for it, we'd have a gain, but it's like a revenue. Expenses and losses also have a similar relationship. Losses are from peripheral activities. If we sell the equipment for less than we paid, we'd have a loss. But effectively, revenues, gains, expenses, losses, and then dividends are closed at the end of the period, which means they all are going to get emptied out into retained earnings. So I just visualize taking my receipts, sorting them into different accounts. Think back to, I think maybe chapter 1 or 2, I mentioned shoe boxes. You take all your receipts, put them in the shoe box, revenues, expenses, and dividends. Those shoe boxes get emptied out into the retained earnings account at the end of the period. So closing the books is actually very easy to do, because if you know the accounts that get closed, all you have to do is the opposite to get rid of them. So if they go up with credits, the opposite of a credit is a debit. If they go up with debits, the opposite of that is a credit. All the closing entries do is transfer the net income or loss, which is the result of revenues and gains, expenses and losses. So it transfers those balances into retained earnings, and then in addition, it's also going to move the dividends into the retained earnings as well. The goal is to establish a zero balance in those temporary accounts, so we start fresh in the next period. Again, it's very, very, very similar to like your W-2. You earn money for a year, and then you start the next calendar year at zero and start the earnings process again. So here they're not showing dividends in their closing entry, and the reason for that is they're just treating it as if you were to debit retained earnings directly when you have the dividends, which can be done, but a lot of times companies use a separate dividend account so they can track it. What does that mean? Not a whole lot. It just means that we're going to have one more account involved in the closing process. So you're going to debit your revenues or gains to get rid of those, and then credit your expenses, losses, and if there are any, dividends, and then the difference gets shoved into retained earnings. So I'm just putting X's for dividends because we don't have any in this example. But what do I mean by the difference gets shoved into retained earnings? Well, the difference between debits and credits. So right now I have debits equal to 130, and then before my retained earnings, I've got 50 under my credit side. So that doesn't balance, and we can't have that in a journal entry. So the difference between 130 and 50 is that 80. So that is going to make my retained earnings balance. Let me give you another example that includes dividends so you can see what I mean. Let's say revenues were 100 and we had expenses of 70 and dividends of 10. So if that were the case, I have 100 on my debits and 80 on my credits, I would have to credit retained earnings to make it balance. Why does that make sense? Well, let's use our retained earnings formula. Beginning retained earnings, let's assume it's 0 in my example, plus net income, which is revenue minus expense. So our revenues are 100, our expense is 70 in my example, so that's 30, minus dividends, which is 10, equals ending retained earnings. Lo and behold, it's 20. So the whole point of this closing journal entry over here is to put the effect of all those accounts into retained earnings. And the effect, as we can see from the statement of retained earnings, is that our retained earnings goes from 0 to 20. It goes up by 20. And that's exactly what our closing entry does. A credit to retained earnings does indeed make it go up. The same would be true if we had a situation where our expenses and losses were greater than our revenues. So let's do that example. Revenues is 100, but now we're going to make our expenses 90 and our dividends 20. So now in this case, I have 110 on my credit side and 100 on my debit side. So I'm going to have to debit retained earnings by 10 to make it balance. Why does that make sense? Well, looking at my retained earnings formula, beginning retained earnings we'll assume is 0 plus net income, which is revenue minus expense. So that would be 100 minus 90, which is 10, minus dividends, which is 20, gives me ending retained earnings, which in this example would be negative 10. So retained earnings went from 0 to negative 10. It went down by 10. And indeed, what does a debit to equity do? It makes it go down. So all you have to remember is get rid of your red accounts, revenues, expenses, and dividends. Yes, you have to remember that gains are like revenues and losses are like expenses. But to get rid of the accounts, all you do is the opposite of what makes them go up. Revenues and gains go up with credits, so to get rid of them, you debit it. Expenses, losses, and dividends go up with debits, so to get rid of them, you credit it. Then you just shove the difference to make the journal entry balance into retained earnings. So the closing entry we would do for Chipotle using all their different accounts, you could see we're debiting their revenue accounts, and then we're crediting all the various expense accounts. And then what we would do is figure out what this number would be. This would be our plug, that retained earnings number. We would add up our debits, which is $12.82. And then we would add up all of our credits. And the difference would be the amount that we put into the retained earnings account. So if we add up all of our credits, we end up with a total of $9.79. And then to make debits equal credits, the difference between the $12.82 and the $9.79 is our $3.03 plug that goes into retained earnings. Once we post our closing entries to all of our related T accounts, you could see that the retained earnings balance is now at the correct ending balance, which would show up on our balance sheet, and all of the other balances in the temporary accounts are all 0. And that's the goal. We're closing out revenue and expense and dividend accounts into retained earnings. So the revenue and expense and dividend accounts end up at a 0 balance for the next period. A post-closing trial balance is, again, another double check to make sure we didn't screw up the closing process. It makes sure that debits equal credits. After the closing process is complete, all income statement accounts have a 0 balance and your retained earnings is up to date, which basically means that the only accounts that would be on a post-closing trial balance are balance sheet accounts. Those temporary accounts would not be on a post-closing trial balance. So only balance sheet accounts would be on a post-closing trial balance because the revenue, expense, and dividend accounts are all closed to retained earnings. And that's it for Chapter 4. Again, I can't express enough, practice makes perfect, so please use the resources on both Canvas and Connect to get your practice in. Please reach out to me through the discussion boards if you have any questions, or you can email me if you'd like to set up a Zoom appointment for office hours.